Hello everyone, and welcome back to our derivatives course. Today we'll look at another option trading strategy, the bear spread using put options. By the end of this lecture, you'll understand how this strategy works, how to construct it, and when to use it effectively in bearish market conditions. Bear spread using put options is a strategy that profits from a moderate decline in the price of the underlying asset. It's constructed by buying one put option with a higher strike price and selling another put option with a lower strike price. Both options have the same expiration date and the same underlying asset. Because the higher strike put costs more than the lower strike put, this strategy involves a net debit. You pay a premium to set it up. This structure provides limited profit potential and limited risk. Let's go through the steps to build the bear put spread. Step 1. Buy a put option with a higher strike price. This gives you the right to sell the underlying asset at that price. Step 2. Sell a put option with a lower strike price. This offsets part of the cost of the long put, but limits your potential gain. The result is a position that profits from a decline in the underlying price, but has both a maximum profit and a maximum loss. Here's how the payoff works at expiration. If the stock price ends above the higher strike, both puts expire worthless, and you lose the net premium you paid. That's your maximum loss. If the stock price falls between the two strike prices, your long put gains value while your short put begins to lose value. This is where your profit increases gradually. If the stock price falls below the lower strike, both puts are in the money, and your profit is capped. The maximum profit equals the difference between the strike prices minus the net premium paid. The maximum loss is the premium paid to initiate the position. The break-even point is the higher strike price minus the net premium paid. Let's work through an example. Suppose the stock is trading at $60. You buy a $60 put for $5 and sell a $50 put for $2. Your net cost, the premium paid, is $3. If the stock stays above $60, both puts expire worthless, and you lose the $3 you paid. That's your maximum loss. If the stock falls to $57, your long put is worth $3, exactly offsetting your premium. That's your break-even point. If the stock falls to $50 or below, your maximum profit is reached. You earn the difference between the strikes, which is $10 minus the $3 you paid, for a total of $7 profit. So the range of outcomes is clear: a maximum loss of $3, a maximum gain of $7, and break even at $57. Notice line starts flat at the maximum loss when the stock is above $60, slopes upward between $60 and $50, and then flattens again at the maximum profit below $50. This shape highlights the limited profit and limited risk nature of the strategy. You know exactly what you can gain and what you can lose. So, when should an investor use a bear put spread? This strategy works best when you expect a moderate decline in the underlying asset's price. It's a cheaper and safer alternative to buying a single put, since the short put reduces the overall cost. From a Greek's perspective, delta is negative, reflecting the bearish nature of the trade. Theta, which represents time decay, is slightly negative. Time works a bit against you. Vega is positive, meaning the strategy benefits from an increase in volatility. The bear put spread is particularly useful when volatility is low and expected to rise. In summary, the bear spread using put options is a limited risk, limited reward, bearish strategy. It's constructed by buying a higher strike put and selling a lower strike put, allowing you to profit from moderate downward moves in the underlying asset. The strategy clearly defines potential profit and loss, making it a disciplined way to express a bearish view while controlling risk. This concludes our discussion about the bear spread using put options strategy. See you at the next lecture.